All right. So now we're going to talk about recognition and measurement of defined benefit plan assets, and then we will talk about the components of the defined benefit cost and so on and so forth. So in terms of the benefit plan, right, as we talked about that there are funded plans and then there are unfunded plans. So this is only there in the case when the plans are funded. That means I, as an organization, I have liability to pay to my employees, right? And that liability, as I said, it's a defined benefit plan. That means it's going to get settled in the future period. So I'm creating a liability in my balance sheet, but I want to in a way do my risk management. So I don't want to in a way keep the liability open. Okay, so what I'm trying to do when you look at your balance sheet, right? So if I look at the balance sheet, and I'm saying, look, I have a liability here, okay, and I want to match this liability with assets, okay, in a way. So that's what I'm just trying to fund my liability, okay, and that's what is what's called funded plan. All right. So how do you look at the accounting? So then, from a funded plan perspective, so they have assets, right? And the assets that needs to be fair value from that perspective, okay. Asset needs to be fair valued. So uh, and then the fair value of that asset in a way helps you determine that how much is a shortfall. Do I have a shortfall? Do I have a surplus? Because assets may have, like we saw in the previous example, right? The assets generated 20% return, right? Whereas expected return was only 10%. Looking at the interest rate environment. So when we look at the fair value of plan assets, the fair value of any plan asset is deducted from the present value of my defined benefit obligation in determining the deficit or surplus. It excludes the unpaid contribution due from the reporting entity to the fund, as well as any non-transferable financial instrument issued by the entity and held by the fund. So if there is anything which is pending, you got to, of course, exclude that in a way from that perspective. And plan assets are reduced by any liability to the fund that do not relate to employee benefits, for example, trade and other payables, and liabilities resulting from derivative financial instruments. So, where plan assets include qualifying insurance policies that exactly match the amount and timing of some or all of the benefits payable under the plan. The fair value of those insurance policies is deemed to be the present value of related obligation. So again, whatever goes, you got to again look at the contract and assess what all are my rights as part of the plan assets. All of that then needs to be fair valued. If there's anything which is an obligation, you got to reduce it, right? That's what essentially the principles are suggesting. And then if there are any reimbursement, right, to say that I'm supposed to receive something from any third party, I think that also you need to factor in. So it will recognize its right to reimbursement as a separate asset, right, to reimbursement as a separate asset when and only when it is virtually certain, right? Again, when we look at the certainty, right, which is remote, possible, probable, more likely than not, and highly probable, and virtually certain, and all kind of probabilities, right, which we are dealing with. So here we are saying the word virtually certain that the another party will reimburse some or all of the expenditure required to settle a defined benefit obligation. The assets are measured at fair value by the entity, and in all other respects, an entity shall treat that asset in the same way as plan assets. Similarly, the expense related to a defined benefit plan presented net of the amount, right? We don't need to gross up all of this. They all get adjusted on a net basis because they relate to the same caption from that perspective. And if the right to reimbursement arises under an insurance policy that exactly matches the amount and timing of some of all the benefits payable under a defined benefit plan, the fair value, right, of the reimbursement right is deemed to be the present value of the related obligation. Okay. So essentially what we're trying to say here, when you look at the, if I have a funded retirement benefit plan, right, which I have funded it, you got to look at the fair value of the the plan asset, you've got to look at any obligation you have, you've got to look at the reimbursement rights you have to look at is there any insurance policy coverage I have. All of that I need to pool together, right? To assess, what all is out there from a fair value of plan assets. If there are any expenses in relation to that, I'm allowed to net it off as well. Okay, so now we're going to discuss in detail the different components of defined benefit cost. Okay, and defined benefit cost essentially means the service cost, the interest cost, the actuarial gains and losses, which are not part of which are treated separately, recorded as part of other comprehensive income, and if there are any settlement or curtailment cost, all of that is what we will look at and discuss in detail. So what all are the components, right? The service cost, right? Which, let's say I as an employee is providing a service. Similarly, the interest cost, right? Which is the time value of money, which I need to unwind, right? All of that is what are different components of defined benefit cost. So an entity is required to recognize the components of defined benefit cost, okay, except to the extent that another Ind AS requires a permit that their inclusion in the cost of an asset, like, we talked about Ind AS 2, which is inventory, or Ind AS 16 on property, plant and equipment, or Ind AS 38 in relation to intangible assets, right? So all of that we need to be careful about. So service cost in P&L, net interest in the net defined benefit liability in profit or loss, and remeasurement of the net defined benefit liability in other comprehensive income. This goes into other comprehensive income, and if there are any other actuarial gain or loss. Okay. So remeasurement of the net defined benefit liability recognized in other comprehensive income shall not be anything which goes into OCI, right? Shall not be reclassified to P&L, right, in a subsequent period. However, the entity may transfer, right, these amounts in other comprehensive income within equity. In a way, let's say when all the plan has been settled, there's nothing which I need to pay or anything like that, then this amount within equity can be transferred to retained earning, for example, from OCI to retained earning, right? That is permissible. All right. So what is the meaning of the current service cost? An entity shall determine the current service cost using actuarial assumptions, right? And we talked about what all goes into the actuarial assumption at the start of the annual reporting period. And if an entity remeasure the net defined benefit liability, if you are doing a remeasurement, right, it shall determine the current service cost for the remainder of the annual reporting period after the plan amendment, curtailment, or settlement, using the actual assumption used to remeasure the net defined benefit liability. And if there are, of course, there could be a scenario of actuarial gain or loss as well in that situation, right? So otherwise, you determine this at the beginning of the annual reporting period. How do you look at net interest on the net defined benefit liability or assets? So if you just kind of reflect on, so we had the projected benefit obligation, then we have the fair value of the plan asset. The net difference between the two, in a way, is your net interest, right? On that is where you end up doing the unwinding, right? An entity shall determine net interest on the net defined benefit liability, multiplying the net defined benefit liability by the discount rate, which is the example which we saw. Net interest on the net defined benefit liability can be viewed as comprising interest income, right? Interest income on the plan assets, right? And interest cost on the defined benefit obligation, and interest on the effect of the asset ceiling, if there is any asset ceiling out there. And interest income is a component of the return on the plan asset, and the difference between the interest income on plan asset and the return on plan asset is included in the remeasurement, right, of the net defined benefit liability. So if there's any difference, the interest and actual return, that goes into the remeasurement, gain or loss, which goes into other comprehensive income. All right. Now, interest on the effect of the asset ceiling is part of the total change in the effect of the asset ceiling, and is determined by multiply the effect of the asset ceiling by the discount rate if there is an asset ceiling. This you may not see in all situation, right? But if there is it, then you need to compute the interest cost on that as well. Okay, so remeasurement comprises of actuarial gains and losses, right? And actuarial gains and losses do arise on because of demographic assumptions and financial assumptions. We talked about that. The return on plan assets, excluding amounts included in net interest on the net defined benefit liability asset, right? And any change in the effect of the asset ceiling. All three components, in a way, are called remeasurement of the net defined benefit liability, and they are the one which goes into OCI, right? This is what goes into OCI, which never comes back to the P&L. Again, I'm repeating this. This never comes back to the P&L. You can reclass within OCI, right? You can reclass within OCI from that perspective. All right. So now we will try and understand this with the help of an example, right? Let's do a detailed example from this perspective. So Sigma Limited is the leader in the shoe manufacturing business for multiple decades, right? Current turnover of the company is INR 12,500 crores. It's a large company. Sigma Limited management is considering to get listed in a year's time. The company employs a large number of employees for its manufacturing plant. Of course, you have 12,000 crores of revenues, which are located in many states in India. Sigma Limited has a defined benefit plan in place for its employees. Awesome. Below mentioned are the details of the plan assets and defined benefit obligation as at 1st April 2019 and 31st March 2020. So we know at the beginning of the year and at the end of the year. Okay. At the beginning, present value of benefit obligation is 2,800. At the end is 3,160. Fair value of plan asset is 2,280. At the end, it is 2,550, right? So again, we're going to look at all the information which is provided. And then there are more details in relation to the plan as at 31st of March 2020. The service cost is 110 lakhs. That information is given. The benefits paid, I haven't paid anything, right? Nil. That means possibly nobody is left. The organization or those who left, they were not entitled to be paid, right? I made a contribution of 222 lakhs during the year and assume the discount rate of 8%. Okay. Now, what are the amounts to be included in the financial statements of Sigma Limited, balance sheet, P&L, and OCI for the year ended 31st of March 2020? Also provide the journal entries to be recognized by Sigma Limited, right? Also provide the journal entries to be provided by Sigma Limited. So we need to look at my balance sheet, P&L, and OCI, and then also look at the journal entries. So what goes into the balance sheet? The liability, right? Or the net asset, as the case may be, okay? And remember the rule, right? That it is also allowed to be set off. That means the for you got to separate it so that the creditors don't have access to the fund assets, right? That's important. So let's go with the assumption that these are separate assets and creditors don't have access to this, okay? So because that information we don't have, so we'll assume that. So and then we got to look at the P&L. What all goes into the P&L is the current service cost and the interest cost, right? We will look at that. And then what goes into the OCI is the remeasurement, right? Gain or loss, which has actuarial gains and loss and other items. Okay. So let's just try and build all of that. Okay. As we look at the solution. So remeasurement, actuarial gain or loss. My opening balance of defined benefit liability is how much? 2,800, right? And my current service cost is 110, which is given information. So all of this is given. My interest on opening liability, right? 2,800 on 8% is 224. And my actuarial loss, so this is the balancing figure. And I have the closing balance of liability also given, which is 3,160. So I have determined my actuarial loss, which is the balancing figure. And that's why it is important for you to understand the different components which goes into this so in determination of my obligation. Okay. So my liability opening plus current service cost plus interest unwinding on opening. Then I know here the closing. So balancing figure is the actuarial gain or loss. All right. Now I'm going to look at my return on plan assets, right? Because I also have the same information there. So I have the plan assets, which is opening balance sheet is 2280. Then I have contributed 222. I have then interest income again at the rate of 8%, which is given, which is 182, right? And then I have the closing balance, which is available. Then this also becomes the balancing number, right? 134 is actually a balancing number, which is like a actuarial gain or loss. Okay. Now I have computed the return on plan assets, right? And I have also computed my benefit liability. So both I know that what is my actuarial gain or loss. So there is a decrease in plan asset due to remeasurement, for which computation is as follows, right? Actual return minus net interest on opening plan asset, which is INR 48 lakhs minus INR 182 lakhs, which is 134 lakhs, which is in a way coming through, right? Which is 48 lakhs minus INR 182 lakhs. So that is what we getting the difference, right? In terms of the remeasurement, okay? Actual return minus net interest on opening plan asset, which is 134 lakhs, okay? So now we move forward. Net measurement would be computed as follows, which is actuarial loss on liability plus loss on return, right? Which is 26 lakhs plus 134 lakhs is 160 lakhs, right? And net interest taken to the statement of profit or loss. So I'm going to look at my what was my interest obligation on my benefit liability, and what is why it's supposed to be interest earned on my plan asset, right? So discount rate into opening, which is 8%, and the difference between the two, right? 2800 minus 2280 is 42 lakhs, right? Is what you're getting as the net interest, right? Opening net defined benefit liability, right? And how the net defined benefit liability is computed, as I said, which is nothing but your obligation minus assets, right? At the beginning of the year, okay? At the beginning of the year. So now I'm left with the computation of the increase decrease in net defined benefit liability. So opening net was 520. The closing net defined benefit liability is 610. Okay. The increase in liability is 90 rupees. Okay. The increase in liability is 90 rupees. Okay. And that's where we now have all the components of this 90, right? Which is that how much was my service cost, how much is my interest cost, how much is my actuarial loss, and then how much in a way I have contributed, right? Which I have already paid. And that delta is where then you should have 90 from that perspective. So if you look at the extractor balance sheet, I have a closing net defined benefit liability. From a P&L, I have all of this, which is what I was saying, my service cost, my net interest cost, and my other comprehensive income. All of that is 312 is what I get here. And in terms of my journal entries, profit and loss account debit, which is 152, other comprehensive income is 160, and to cash 222 is what we paid, right? And to net defined benefit liability is the increase in liability, which is 90, right? That's how we get our overall in a way journal entries as well. So it's I think the whole point here for you to solve all of these tables, right? What you just saw, you get these tables as part of the actuarial report. Okay, it's not that you don't get it. Okay, but I think the key for us is to understand how all these tables are being built. Okay, and you got to look at it in your mind step by step. All right. So first is I got to look at my liability. Okay. So what was my liability at the beginning of the year? Then I need to look at what was my service cost for the year. Okay. Then you need to look at what is my interest cost on my opening liability, right? And then in a way you have an actuarial gain or loss, because let's say an actuary estimated this much was your interest unwinding, he may have changed it, as a result of which this results into an actuarial gain or loss. And then you have a closing liability. Okay, the difference is the actuarial gain or loss. Then if you have a plan asset, same step you need to follow from a plan asset, right? How much was my opening, how much was the return I was expecting, how much more money I have contributed, is there any withdrawal which has happened, what is my closing, and what's my actuarial gain or loss in relation to the plan assets. Okay, and then so what all needs to go into the P&L? What goes into the P&L is your service cost and net interest cost, right? Net interest cost, which is with reference to your obligation and the funded status, right? That difference between that goes into the P&L. And then you have the actuarial gain or loss, which is nothing but on the obligation side, on the asset side, on the remeasurement side, all three in a way, the actuarial gain or loss. You look at that, and then depending upon how much more contribution you have made, it results into any increase in liability, or it may result into increase in asset from a financial statement perspective. I hope all of that is clear to you. P&L debit 152, OCI debit 160, cash, which I paid 222 here, and net defined benefit liability. Okay, so we're going to quickly summarize what we've talked about, right? Components of defined benefit cost is a service cost, goes into P&L. Net interest on the net defined benefit liability or assets, that also goes into the P&L. Remeasurement goes into other comprehensive income, which is a component of actuarial gains and losses, return on plan assets, and change in the asset ceiling effect. All three in a way goes into your other comprehensive income, right? And you got to be clear in terms of how to visualize all components, right? That's extremely important.